Welcome back to the Capital Flows podcast. We have been seeing the credit spigot in the economy turn on as commercial banks issue more debt into the system, liquidity increase, and capital move out the risk curve. And this is something I've been laying out for a while now. And what I wanted to do is explain, one, how those flows work, and then two, explain how that is setting up for where we're going. And that is going to be incredibly important because we are in a melt up right now in risk assets. We have risks to bonds, and we have some significant changes that are happening in the underlying economy and financial markets. But there is going to be a moment in the future where the seeds that all of this liquidity and credit are laying in the ground are going to sprout, and it's really going to result in more volatility. And those are things that are just really important. I cannot emphasize enough how important it is to be prepared for that. And so that is what I'm going to walk through in this presentation today and explain for you. And what I will say is that at the end of this presentation, I will have something for you that really helps you be guided through this entire process, and it'll be 100% free for you, but I'll lay that out at the end of the presentation. So the things that I want to cover today are: what is the credit cycle? What is money? What is liquidity? And the reason why these ideas are important is because if you can understand how each of these work, you will have an understanding of where we're going. And so the problem is you cannot just come and just see what is happening. You need to understand why things are happening. In the same way that you can, look at a clock and say, oh, okay, I know what time it is. That doesn't mean you understand how a clock is put together, or you could even fix a nice watch or a real clock or something like that. I think that's a great analogy for when you come into the market. You might see stocks up, bonds down, gold doing this, Bitcoin doing this, but do you really know the why behind it? And does your view of the why actually have predictability over the price? And so the last point I have right here on this slide is, if you can understand what is happening, so what's taking place today on whatever trend or look back you're looking at, what is taking place, and you can understand why it's taking place. If you can understand both of those, then you are going to be set up to understand where we're going and begin to understand the probabilities for the future. If you don't understand why things are taking place the way that they are, it is going to be incredibly difficult for you to have any clarity on the future probabilities for what will take place. And so that is what we are going to cover. And the credit cycle, money, and liquidity, I want to cover: how does credit function, how does money function, how does liquidity function, and how does all of this connect to financial assets, goods, and services in the economy. And so the main idea that I want you to take away is that there are no rules of what should be happening or what a true definition of money is. This is really important because in today's world, we see not only the media, but a lot of different people pushing narratives about their true definition of money or something like that, regardless of what it is. And the problem with that is that there is no one to enforce that definition. There is no single individual or single governing authority that can say this is the true definition of what these things are. There are only asset-liability relationships with varying levels of duration risk and credit risk. This idea that a currency is a medium of exchange, store of value, something like that, again, those are helpful things to know about how these different types of currencies can function and something like that. But again, there is no actual definition for those things, or there is no enforcing power that says you have to believe that this is the definition, and if you don't, then you're in trouble or something like that. There is only asset-liability relationships with varying levels of duration risk and credit risk. what is duration risk? It is real purchasing power, and credit risk is really the presence or absence of nominal cash flows. And so really, if you want to break it down, it is the uncertainty in real purchasing power and the uncertainty around nominal payments. Let me explain this a little bit more. So if you have U.S. Treasuries, which are functionally risk-free, and in one sense they're not risk-free because you could still have the U.S. government default, which historically it has in the past. And the uncertainty, again, that was a long time ago, so very different situation now, but we all functionally view U.S. Treasuries as risk-free. So if we have a quote-unquote risk-free view about U.S. Treasuries, there is still real purchasing power that changes over time, which we call inflation. And then there's credit risk, which is about the uncertainty about those nominal payments over time. Is a specific corporation, like, whoever it might be, Carvana, for example, who, really rallied in a massive push up, and then they actually had some massive credit risk because the entire, used car market and all these other things began to change, and there was uncertainty, right? There is a reason why companies have default risk. There's a reason why companies can actually default, because they won't meet their nominal payments over time. And there is uncertainty about both of these. And so asset and liabilities are the accounting mechanism, the accounting functions that we use to define relationships between different agents in the system. And so in the financial system, every person's asset is another person's liability. That's a really key foundational point if you're trying to think about this idea of money or assets or credit cycle or whatever it might be. What does that mean? It means that if you take a mortgage out on your house, that is a liability to you, and it is an asset to the bank. And when you put your money into a 401k, and that 401k goes and then buys corporate bonds or mortgage-backed securities or whatever that might be, those are assets to you and liabilities to someone else. And what we have in any type of corporation or agent or whoever it might be, different parts of the capital stack that represent that. Even equity in the capital stack is technically a constraint on the business that indicates you have some type of constraint over them where they have to pay you, or you have a voting right, or you have some type of claim on the underlying business. And so that's important to understand. The thing that we're going to move to now is that every asset functions on a spectrum of credit risk and duration risk. And here I just have a very simple breakdown of, okay, you have just cash and cash deposits in a bank, right? The duration risk of that is functionally zero. It's very low. Where, if you have your money in a money market fund, you're getting paid and you are not buying, TLT or long duration bonds that actually can move a lot if inflation rises or falls, right? And the credit risk for that is low. And then we have treasury bills, and you have that kind of same dynamic. And then you have treasury bonds where you have a higher degree of duration risk right here, but then you still have low credit risk, or functionally no credit risk. And then corporate bonds, you have duration risk in those, and you have credit risk, right? So that's why when we come up with credit spreads, it represents actually credit risk as opposed to duration risk, right? And then you have obviously equities, mortgages, gold, everything across the risk curve. And, on the far end of the risk curve, basically the more risky companies are, which I'll cover in a minute, the more sensitivity they have to changes in these types of conditions. And you have things like equities, low quality equities, you have Bitcoin, crypto, meme coins, NFTs, everything across the entire risk spectrum. And all of those function with duration risk and credit risk. And so to summarize, there are no rules. We use the asset liability accounting mechanism to structure relationships between agents, and all assets and liabilities fall onto a spectrum of credit risk and duration risk. And so what drives credit risk and duration risk? That's what we need to ask. Duration risk, again, is the uncertainty in real purchasing power over time. This is primarily driven by inflation. Credit risk is the uncertainty about nominal payments over time, and that is primarily driven by growth. And in this environment, I have a breakdown here of how to think about these flows as they connect together and how we need to think about that in connection with the underlying economic system. And this is from the Substack that I wrote on this a while back. But in an environment of accelerating growth and elevated inflation, nominal cash flows rise faster than discount rates and real debt burdens fall, compressing risk premiums, pushing capital outward along the risk curve from bills and high-grade sovereigns toward high-yield credit and equity, while abundant liquidity and accommodative funding conditions reinforce this rotation. When credit issuance itself ramps up, the primary market supplies leverage that lowers spreads and lengthens effective duration, creating a reflexive feedback loop. Tighter spreads spur more issuance when it attracts further risk-seeking capital. That'll be important. Basically, when credit spreads move down, more banks want, more people want to take out credit. And that'll be important for a chart that I'm going to cover later. The cycle reverses when growth momentum falls, stops, or disinflation sets in. The funding costs rise relative to expected cash flows. So you have liquidity, support wanes, issuers retreat, banks say, I don't know what's going to happen right now. I'm going to pull back my credit issuance. Again, that'll be important for later as well. And we have this entire cycle of global liquidity changing, balance sheet constraints being loose or tight, and really causing these regime shifts to be abrupt. And so the examples that I would want to cover where you say, okay, I understand credit risk and duration risk. Can you give me some examples of how those have functioned during two different periods of time? And in the chart here, you can see just the S&P 500, and we're going to go to the extremes and say, let me see an extreme of duration risk and credit risk. In 2008, you had the GFC, where growth was collapsing in the underlying economy. But you'll remember that during this time, you had deflation, right? The economy went off a cliff and prices went down, which pushed equities lower. That was the driver behind it. Now, the opposite extreme is in 2022, right here, where you had inflation accelerate and you had growth still remain positive. So it was an inflationary bear market. And what that really means is when we came into 2022, well, actually, let's start with 2008. In 2008, everyone just said, listen, I don't know if these companies are going to be able to pay their cash flows, so there is risk to their nominal payments. Inflation's coming down, so having dollars is actually a great thing, and I want to be long bonds, but I don't know who's going to pay, their debt service payments, so I need to pull out. Inversely, the opposite thing really happened in 2022, where everyone said, the market overall, Apple, Mag 7, all of those top names, we know that they're going to still keep making the same amount of money because we're not actually having a recession right now. Growth isn't contracting. And you'll remember through all of 2022, CPI and NFP prints were the things that caused selling pressure. And during that entire time, you saw growth and tightness in the labor market. So think about it. If you have the economy strong, but then equities are selling off, why in the world would that happen? And the reason is because of duration risk. What we were saying is the underlying cash flows are remaining constant. They're not moving. But we're revaluing those because there are so much money in the system that's causing inflation to rise, which means we need to revalue everything. And so that's an example of the two extremes between credit risk and duration risk. The same thing for Bitcoin, right? When you had the drawdown in Bitcoin, understanding why that's taking place is critical. Because, again, 2020, you had the recession during COVID, all that. And then you also had this revaluing of Bitcoin in this bear market in 2022. Now, here's the thing. People are going to say, well, it's, it went up over time or stuff like that. Listen, when you have a drawdown from $60,000 to, I think it was $15,000, a 76%, a massive decline. Massive decline. When that happens, it would be super helpful to know how the balances of risks are developing. It's just the simple thing of, do you want a dollar cost average at $60,000 or $20,000, right? Which is why understanding those underlying changes is really important. And then you have, in terms of duration risk, this is just a chart of TLT where you can see this is really one of the largest drawdowns in history, where, long duration bonds have just sold off from their extreme. And what happened in COVID is we set the stage for inflation because the Fed was so accommodative, growth went so low, and you basically had an entire compressing in the entire system that created the conditions for a massive sell-off in bonds, which is, again, during this entire time, we have not had a recession. We have only had a repricing of duration risk. And so this brings us back to, okay, how does credit function? How does money function? How does liquidity function? How do these connect with goods and services in the underlying economy? And here is what I would say about this, is that credit is directly connected to an asset-liability relationship between two parties, primarily commercial banks, because the Fed is not issuing credit, right? They do not have a direct spigot into the economy. They change bank reserves, they can have indirect effects, but the Federal Reserve's balances, their reserve balances, are not legal tender, which just means that even the quote unquote, money that was put into the system during COVID was done through a fiscal impulse monetized by the Fed, as opposed to the Fed being the one that is directly giving, these payments to everyone, right? Because that's why we had this massive increase in debt for the US government, right? It's because that was from the bill that was being passed, right? So credit is really about how it is functioning between two different agents. Money, again, there is no perfect definition for what money is. What we have is a spectrum of assets. And typically, what you see is money being characterized by those shorter term assets that have very low credit risk and duration risk. But as you have more of that increase in the system, money moves out the risk curve, right? And everything is denominated in that fundamental currency, right? And what I would say is, just on a personal note, when I think about assets in the system, I think about them as just functioning on the credit risk spectrum and duration risk spectrum. I don't think, the dollars in my hand are money and everything else is risky. If I hold paper currency, yes, there is a low credit risk for that. I am still holding an asset, though, that gives me a claim to something, right? And if that claim becomes shaky or something like that, again, that's why people will burn money or, get rid of it or something like that, or, they're carrying around wheelbarrows in places with hyperinflation or something like that. That money in itself only functions in a relative relationship to an asset liability makeup, to a relative relationship to other agents in the economy. So that's important to remember. And then in terms of liquidity, liquidity, especially in financial markets today, a lot of it is driven by the Fed and private sector liquidity and things like that. But what I would say about liquidity is that it is directly connected to and functions in a reflexive relationship with all of these different things. And liquidity is really broken up into interest rates and then the quantity of these high quality assets in the system. And these link with financial assets, goods, and services, because goods and services in the economy are obviously denominated in the US dollar, right, for the United States and for whatever respective country that is. And then you have, obviously, assets priced in that same currency, right? But you will remember that any asset or goods or services or anything like that, it is functionally a pair trade, where if you are buying the S&P 500, you might think in your mind, oh, well, I'm buying that. But fundamentally, you are getting long the S&P and short dollars, right? Everything is a relative relationship when we have assets and liabilities in the system. And so the key thing is that if you have small changes in money in the system, that can have very large changes on financial assets, goods, and services. And so what I would say is that you want to take your view of growth in the economy, your view of inflation, and that informs your view of credit risk and duration risk, which informs your view of assets. This allows you to know the why behind a move in an asset and not just that it's moving, right? And you can see periods like the extremes that I showed of 2008 and 2022, right, where you saw changes in the S&P 500, but you want to say, okay, but what is the reasoning behind that? Why is it doing that? And everything comes down to, in my view, fixed income and FX, because it is the asymmetrical linchpin on which all assets, goods, and services rest. And so small changes in interest rates and FX create massive changes across the duration and credit risk curve. And so what I would say is that fixed income and FX are really two sides to the same coin, because an interest rate is the amount that you're paying to use money, right? To use whatever that respective currency is. And that is directly connected to the value of that currency, which is why a lot of times you have nominal rate differentials or changes in the differentials of, two different central banks or something like that impact the FX rate, because you are having changes in your ability to pay versus, supply and demand for using that respective currency. And so what is happening, why it is happening, how does this set the stage for where we are going? And so what I want to do is say, okay, let's take all that knowledge that we just went through, all of those ideas, and let's connect it to what's happening right now, why it's happening, and then connect it all to, are we going to continue to melt up in equities? How is that setting the stage for any type of potential pullback or market crash, and how should we time those? And so the starting point that I want to go through is, this is a chart of credit risk and inflation risk. And you will notice in the chart right here, the credit spreads are in white, and you can tell that they spiked up during the tariff risk and they have come back down. Again, right here, when we were at the highs, there was still expansion in the labor market. We were not seeing an actual recession. Everyone was betting on them, and then they realized, oh, wait, that's a bad idea. As that has come down, you have seen growth risk move back up, and the market is pricing about 2.5% of inflation risk for 10-year inflation swaps. And so what we are seeing is growth risk remain low and move down as inflation risk moves up, which again, credit risk moving down, that's supportive to U.S. assets. Inflation moving up, that is also for the time being supportive to assets, but that's negative for long duration bonds when you have inflation expectations rising like this. If inflation expectations break out, then that's going to be very negative for an asset like TLT. And so this connects to, okay, well, how is the Fed really functioning in this period of time? This here is a chart of the 12-month interest rate in white, and then 1-year inflation swaps. So we're saying, let's look at the short-term changes in the Fed stance, which is represented by the 1-year rate, and then also 1-year inflation swaps. And what you will notice is the Fed has paused after their entire hiking cycle and then their higher for longer regime. They have paused in this range. And we've been chopping around a little bit in this range, but you'll notice that when the Fed is pausing and they're not changing the price of money, you have inflation expectations rising, which means there's a increase in the supply of money in the underlying economy. This is from just supply and demand imbalances, and then also just because you have an expansion in the labor market. when you have more people getting hired onto jobs, that increases the amount of money in the system. Because when you hire someone on, you are now paying them, and that payment gets used by them to go spend in the real economy. And that functions in a reflexive feedback loop. And so what we're seeing right now when you have this spread narrow is a positive liquidity impulse, because you have the Fed falling behind as inflation rises, actually in a very similar way to what we saw in 2021. And so the problem with this is that everyone is getting misdirected by this setup by focusing on things like a recession risk or the fact that Trump is talking about replacing Powell or things like this. And I see headlines like this come across, which is just totally consensus that Powell is obviously not going to be around next year in terms of, the main guy at the Fed. And Trump has already talked about this, but here's the thing. That's almost a year away. Everyone is trying to price the market for something that's going to happen in 1 year. It might move things around a little bit, but everyone is so focused on the short-term headline and forgetting that there is so much that can transpire between now and the middle of next year. Just think about all the stuff that has taken place between right now and the same period of time last year. It's been massive, right? All of us have changed our views, have adjusted, have adapted, have updated every single thing that we think. So what we're seeing is inflation risk rise, growth risk fall as credit spreads move down, but then everyone is focusing on things like this. And then you'll notice, this is one of the charts that I shared in the last video that I did, which is on the Substack and the YouTube channel and everything like that. But you will notice that right here in this period of time, you are having a steepener twist and bear steepening in 10s, 30s as the Russell is rallying. When that is taking place, when you have a steepener twist, you have longer term rates rising as shorter, 10-year rates remain, they're rising but not as fast. That happens when growth is accelerating. And then you have at the same time the Russell rallying as well, which is the companies that have the highest sensitivity, right? That's why they were really in a range this entire time. And you saw 2021, you had their rally, you had 2022, you had a drawdown, and they underperformed the S&P for a lot of 2023. And then, you had a bit more of a trend here, but then you had this drawdown. And when you have rates rising and the Russell rallying, then you know that there's a lot of growth in the system, because you have the underlying cash flows in the economy rising at a faster rate than interest rates are being, restrictive for the underlying economy. And so that is showing capital move out the risk curve. It is showing duration risk increase as the curve is steepening, but then it also is showing credit risk decreasing as equities are rallying. And at the same time as this is happening, you are seeing all of the low quality companies rally really aggressively. During 2021, you had this massive impulse of liquidity, and it caused basically every crappy company in the entire United States to rally at a rate that we've just never seen in history. And you had this massive run up and this massive retracement. And these are all the companies with the most amount of debt, with the highest risk, the ones that would easily default. Now, what we're seeing is them rally off the lows as interest rates have risen from those lows, right? Where we had the tariff risk and everything like that. When that is happening, that is setting the stage, because it is telling you that there is a lot of credit in the system. There's a lot of growth in the system. And you also saw shorts get squeezed with the Goldman Sachs most shorted index rallying, and we're almost back at a high. So you're seeing capital move out the risk curve. You're seeing shorts get squeezed. And you are seeing all of that move in confluence with the yield curve in the fixed income market. Why do we have this entire thing where everyone is off sides? And this chart shows the Atlanta Fed Nowcast basically projecting out what is taking place in the different components of growth. And you'll notice that right here at the contraction, when everyone, when real GDP was nowcasted at 2%, what was that from? It wasn't because the services sector of consumption was in contraction, it was just because there was an extreme in the import-export function and things like inventories. So you had one line item of GDP in contraction. And again, during that time, if you go back on the Substack and look, basically said, look, you have all of these line items concentrated, or the contraction in these line items concentrated in only one area, and the other line items are all expanding. So when that happens, you know that a recession is highly unlikely, and that's why we've seen jobs actually get added to the labor market during that time. When that takes place, and then also you have not a significant change in, macro liquidity, then it's pretty bullish. And here is just a chart of federal bank reserves, and you'll notice that we really haven't changed much. We're still in this range, which means liquidity is still accommodative. We're not seeing a massive change driven by the Fed, same with the TGA. And so during this time, you have had cross-currency basis swaps remain elevated, which just means the quantity of dollars in the system remains accommodative. So when these are moving up, quantity of money, specifically dollar liquidity, is remaining accommodative or rising. And during that drawdown that we saw, you will notice that the chart up here is of high yield issuance. And you will notice that during this time, banks were still issuing credit. On a year-to-date basis, this is how much commercial banks, broadly speaking, there's some qualifications for that, but are issuing credit. And it's compared to the same time last year. We're issuing more high yield credit than we were in 2023. A little bit less than 2024, but it's still a pretty significant trend. Notice that all of the commercial banks were doing that at the same time that all of the commercial banks were saying what? Goldman Sachs sees a 45% of recession and stocks can't hold up. And then Jamie Dimon comes out, is really bearish, throwing all of these narratives all over the place. And again, their banks are doing something different behind the scenes. And so at the same time you're seeing that, when you see capital move out the risk curve, it is going to impact things like the IPO market. And here's just a chart of IPO value, right? And it's basically reflecting value, deal flow, and those all are, at least right now, moving in lockstep. And what we are seeing is during 2020 and 2021, you'll remember we had a ton of IPOs, SPACs, everything like that. What do we see now? We're beginning to see these same volumes begin to tick back up. And that was taking place during April, right? So you had everyone still saying, well, maybe we need to be cautious or whatever that might be. But when there's so much liquidity in the system that you still have the IPO market really running hot compared to 2023 and 2024, it's a signal that there's a lot of money and liquidity in the system. And so where does that bring us with stocks? What we have seen is a rally off the lows. And now we have seen a rally after all the geopolitical risk that took place and a push to all-time highs in equities right here. At the same time, in bonds, we were remaining below the highs that we had during the rally in March and April. And in my view, right now, based on all the macro signals that we're watching, all of the data, if we pull together every major data point, market point, everything, we are likely to move higher in stocks and remain above this level right here. Could we have a pullback here or there? Sure. But we are likely to remain above this level in stocks where we had the geopolitical risk, and then we are likely to remain below this level in bonds because of the growth in inflation. And then for Bitcoin, in my view, we're likely to remain above this 100K level and push higher. And so what are the risks to this entire setup that we have? The biggest risk to the US equity market is the long end of the curve and long end yields blowing out and the Fed losing control of the long end and the FX market at the same time. That's really key. Because if the Fed loses control of the long end, that puts them in a very difficult position. Why? Because if long end yields blow out and the Fed says, well, we're just going to let them blow out, we're just going to see what happens, right? That's going to start putting real pressure on the economy. It's going to cause vol to spike up, and it's going to begin creating much bigger issues for them to get financing and things like that. What the Fed could do is do some type of switch up in their duration issuance or yield curve control or something like that. Again, I don't think they're going to do that. They have a lot of things before they did yield curve control. But just remember, in Japan with the BOJ, when long end yields began to rise and the BOJ didn't want yields to rise and they did yield curve control in the 10-year, what happened? Every single time they did yield curve control, the yen just collapsed every single day, if you don't remember that. And so the same dynamic can happen, right? Even though the dollar is the US reserve currency, it doesn't mean that you can't have massive moves in the interim on that base of the dollar being the reserve currency. And so the biggest risk is if you have some type of change where they lose control of that long end because, again, inflation is accelerating, growth is rising, and equity markets have just pushed to all-time high valuations again, and we are in this melt-up mode similar to 2021. And so you will notice that 30-year interest rates, again, that's an upward trend. That's super clear. And we are likely to push above 5% in my view. When does that take place? There's some qualifications for that I've laid out in the Substack and how to think about that. But we need to see a lot more changes and a lot more, pressure on the Fed from inflation. And, in my view, if you have long end rates blow out, that's what begins to create a risk for this melt up in equities. And that's going to begin putting a bit of a ceiling on how high equities can rally. Now, the incremental risks around that and how to map that are going to be important. I'll lay it out in a moment. But the dollar, you'll notice, this is just the DXY index, it sold off during the equity sell-off earlier this year. And that's a bit of the risk where if you have the dollar continuing to sell off and you have people exiting U.S. assets, that is really what puts the Fed in a difficult place. Because if they try to step in, they're just going to push the dollar down even more and create even more risk. And in that situation, people are saying, oh, well, the Fed's stepping in, they're doing this or that. But that can still cause risk assets to sell off. I mean, just remember, earlier this year, the dollar sold off with risk assets, right? And remember, any asset, S&P, Bitcoin, whatever it might be, it's priced in what? The dollar. And so you need to have a view of not only Bitcoin, but also the dollar and how both of those are changing. And so if you understand how the risk reward of assets is developing, then you can know how global central banks are beginning to lose control again. And you will have really a head start trading assets across the entire risk curve of stocks, bonds, Bitcoin, alts, NFTs, everything in between, right? But the key thing is that where are all of these changes starting? They're starting in the fundamental base of the system, which is connected to FX and interest rates. And that is what reverberates across the entire duration and risk curve. That's why if you really want to make large gains in all of these assets across the risk curve, whether it's stocks or Bitcoin or alts or gold or whatever it might be, the thing that you want to develop a knowledge in and track the closest is interest rates and the FX market and how those are all functioning. Because small changes in global central banks have massive changes all the way down the duration risk curve and everything in between. And so that's really where the fixed income market, in my view, and the FX market, it'll begin pricing the marginal risk, and that will reverberate across the risk curve. That's going to happen before risk assets sell off. So, you're going to have a pricing of that risk in those markets first, which is why you want to follow them so closely over the next, I would say 3 to 6 months. It could be sooner, but that is what is going to either fuel this melt up in equities further or begin to put a lid on it and change everything for how it's functioning. And you will notice that, implied volatility for FX, it has been compressing in this range. It's actually been a little bit of wider range than, in terms of historical vol and some other things, than, bonds and things like that and rates. But you will notice that we're having a bit of a crash and fall in FX vol today. If you begin to have a change in that, and that would need to be, rising in connection with some other correlations, some other things that I'll lay out, then that is going to begin creating risk for this melt up in equities. Right now, we are still skewed to the upside. And so I'm still holding all the longs that I have, and I'm waiting. But the important thing is to have, preparation and redundancy planning for all of this. So how do we prepare for the risks? Number one is redundancy planning, and not just going into things blindly and hoping for the best. Hope is not a plan. And then the second thing is monitoring all the flows on a daily, weekly, and monthly time horizon. This is important because, when you are monitoring these changes, they'll first start on an intraday basis, and then it'll extend to a weekly time horizon. And when that begins to take place, then okay, you know what? Let me begin pulling back my exposure a little bit. And then you say, oh, you know what? There's actually some really significant macro changes taking place. I'm already halfway out. Let me take some more gains on the longs I've been holding. And now I can adjust further and actually maybe even get short to be able to capitalize on those changes that are taking place. For now, we are still seeing an alignment on all those time frames, right? So it's key to moderate your views. And number three, dynamically adjust those as those take place across time. And so those are the main things to prepare for preparing for the risks that are going to take place. Because at the end of the day, when you have this type of market, it's the type of market where you want to be long. But you don't want to just be blindly long. You want to say, okay, there are risks. I need to take these into account. I need to have a plan, and I need to think clearly about it, because I don't want to just panic buy or panic sell, right? That's the worst thing that you could do in this type of market. And so how do we pull all these things together? How do we map all of those things in terms of the redundancy plan, the flows, and dynamically adjust? And the entire point of the Substack is to provide those signals incrementally across time so that you can have a clear process for how those things work. And so in the Substack, if you're watching this video, linked below will be an entire playbook for how to think about everything that I've laid out in this presentation, not only on an educational basis, but also the redundancy plans and signals to watch for where we are in this cycle. And that playbook will be 100% free. Wherever you're watching this, there'll be a link below. And if you're a free subscriber on the Substack, you will be able to get that and be able to get all the future research as well that is coming out. And then what I would say is, in terms of monitoring what is taking place on a daily, weekly, monthly time horizon, that is the entire purpose of all the models that are on the Substack and all the research that I lay out, right? Knowing that nothing has changed and that you want to hold a position or whatever that might be, or incrementally change your exposure, is incredibly important, right? And so that's why everything is laid out on the Substack in the manner that it is, so that you have all of the educational materials, you have all of the research, you have all the models, everything is laid out so that the main thing comes down to your ability in markets and your execution and being able to dynamically adjust your exposure as things take place, wherever that might be, whether you're in a business, running a portfolio, or whatever it is. So those are the main things that I wanted to cover. And I would just say, on a personal note, all of the educational stuff that I put out on the Substack, I make free. Just because I know there's a lot of noise out there, and I really like just being able to put all the educational stuff for free, because I know how hard it can be to be able to go through all this stuff, to understand all of these flows, to kind of start from square zero and understand how all these things are functioning in real time. So the playbook will be linked below wherever you're watching this video. And this weekend, I will be publishing a report that further explains the developments that you want to be watching in the S&P 500, in the bond market, and then also the specific trades that are likely to set up over the next 1 to 2 weeks in those markets, whether that is adding exposure or beginning to pull exposure back. So that will be on the Substack over the weekend. And with that, I will see you guys soon.